have Sister Firouz Buhedma. She is a senior tax professional at H&R Block. She has been working there for 6 years. She has experience with individual and business returns. She also teaches the fundamental of tax returns at the H&R Block Academy. We also have Sister Hebatollah El-Kady. She is a senior tax professional as well. She has also worked at H&R Block and is currently working with Intuit Canada. She also owns her own tax business called Heba Tax Insights. And she also has experience in teaching taxes and writing tax article. Welcome, sisters.
Welcome. Assalamu alaikum wa rahmatullah.
So the hot topic, it's the end of February and everyone is racing to do their taxes. 2020 was a crazy year for a lot of people. A lot of changes has happened. How do you guys feel about 2020?
So far, a lot of changes. Some of them were good, some of them were bad, but we have to embrace the good so that we can move on. Sure.
Yeah. People are confusing on a lot of stuff for 2020. So it's going to be an interesting tax year.
All right. Okay. So why don't we start off and just ask the basic question. So what is the basic 2020 changes for 2020, right? Like, did any of the existing credits change?
Sure. Go ahead.
Go.
Okay. Every year we do have changes in basic amounts, tax index. For example, this year, the basic personal amount has changed between two levels. People who have income of 150,473 or less, they will receive, or they can claim, a higher personal tax amount than anybody else, which is 13,229. People who have income more than 215 and some more dollars, $215,000, they can only claim 12,298. So what is that basic personal amount? Canada, basically CRA has decided that yes, you are taxed on all your income, on your world income. However, they're going to give you some tax breaks, that we call them non-refundable tax credits. So you will get back 15% of the basic personal amount. So let's say that you have you've earned $12,000 as income in the last year. The very first tax bracket we have federally is 15%. If you're paying 15% on the 12,000, and then you're claiming another 15% on the basic personal amount, you're canceling your taxes. So to give a break for people, since COVID was a crazy year, they increased, or they enhanced, the basic personal amount for people with a certain amount of income. And that's the very first change that we have. Tax brackets, we still have the regular 5 tax brackets that we have federally, which is 15%, 20%, 26%, 29%, and for people who earn above $214,000, they pay 33%. That's only federally. The amount, the percentage has stayed the same, but the dollar has been indexed, so it changed. So people this year who earn $48,000 and $500, they only pay $1,500. Last year it was less than that. Another change that we also can see is the regular deduction. We call them payroll deductions. Everyone who works as a full-time, part-time, any employees, they actually have to contribute on something called Canada Pension Plan and Employment Insurance Program. The Canada Pension Plan that actually provides seniors with pension when they retire. In order to guarantee this kind of retirement plan, you have to contribute throughout your working career. It has increased, and it's been increasing, and it's actually going to keep increasing in the next few years. we have a base amount. You pay around 4.9% of your earnings. You pay that or contribute that towards your Canada pension. But there is an enhanced amount, around another 0.3% that you also have to pay to the Canada pension. That enhanced amount, as a tax break, CRA said that yes, you do have to contribute it, but at the same time, you can claim it as a deduction. So you're contributing to your pension when you retire, but at the same time, you can claim that enhanced amount as a deduction. Similar with EI, changes every year, the EI contribution. EI is a short form of employment insurance program, and people who are employed, they have to participate in that program in case they lose their job for any reason, or if they go into maternity, parental leave, the CRA can cover them. That EI also, it changes every year. The other change that I can think of that is general right now, we're not going to talk into details. The general one is the late payment interest, because people have been finding it difficult to cope with what's happening and loss of income, loss of jobs. So CRA has said people who are paying their taxes later than April 30th, they are they give them a relief until April the year after, which is April 2020.
Yeah, we have the carbon tax credit.
Yes.
This year is going more. So for the person, for the one adult is 300. If there's a spouse, it's going to be 150. And then for each kid, it's $75. So if it's a family of 4, they get $600. And it's really a break for some people too. The other thing that we have is late payment interest relief. So people who have income 75,000 or less, if they have owing to the government, they're not gonna be paying any interest until April 30, 2022.
Oh, 2022. Okay, I was going to go back and ask because I heard you say April 2020, Sister Heba. So
April
okay.
2022.
2022.
April 30th, so the end of April, like 2022. So next year.
Originally, it has to be due by April 30th of this year, 2020. If they do not pay it by that time, it was actually postponed, or they have a relief, basically. So they have to pay it, but it's a relief until 2 years from now.
I see.
Relief on the
1 year from now. Relief on the interest only.
On the interest only, not on the penalty.
Yeah.
I see. Okay. Moving gears. So I read about the new digital news subscription credit. Can you please explain how it is different from the Canadian journalism labor tax credit?
These credits are new. Again, there is a big demand right now. We're moving forward, and there's a big demand of receiving news digitally. So we do have 2 different credits now. One of them called the digital news subscription expenses. It's a non-refundable tax credit. So, and the other one, it's a credit. So let's the difference between these 2. Non-refundable tax credit, it's designed to reduce your tax liability to 0, but it never produces a refund. So if you have this amount to claim, if you don't have any income to claim it against, you're not going to be able to utilize it. The other one is a credit, is a refundable credit, which means whether or not you have income, you do receive a credit for this amount. So the digital news subscription tax credit is paid by individual to a qualified Canadian journalism organization. There's a list of these organizations in the CRA website. And the qualifying subscription expenses, basically this paid in the tax year. It started in 2020 and it's going to keep going to 2024. It's offered, the organization has to offer a digital news subscription or combined digital and print. It cannot hold a license defined under what we call subscription to bracket 1, which means the news has to be given by a digital or print news. It cannot be broadcasted by TV or radio. The subscription entitled the individual to access content in digital form only, and that's the primary original written news content. Now, the other one, the Canadian Journalism Labor Tax Credit, you claim it on a different line after you calculate all your tax liability, which means if you have this amount, you can create a refund. This is designed for members or partnership in a qualifying journalism. So one of them, the previous one, if you are subscribed in the journalism. This one, if you are a partnership in that qualified organization. So it must first be designed as a qualified, registered or designated as a qualified Canadian. Again, the registration goes by that organization, and a list of them can be found in CRA. The credit is 25% of the expenditures. The expenses, what do they mean by expenses? Is the amount of salary or wages you pay for your newsroom employee or the organization of the taxation year. So you can get back 25% of that. However, there is a condition that 75% of the time is spent and engaged in production of written news. It cannot be, again, it cannot be part of a radio or TV news. It has to be written and given to be people in the digital form. That's the difference between these two.
Thank you very much for that. So what about students? Are there any changes for students this year?
Yeah, we have the new Canada training credit. It's a new line 2, the same as the journalism. It's on line 45350. It's eligible tuition that you paid or for courses taken in 2020 or any years after that. It's for people who age between 26 and 65. The credit will be the lesser of how much you paid for the tax, or 50% of your eligible tuition. So the credit is $250 per year and maximum 5,000 for your life. So if you go for school between the 26 and 65, the maximum you can claim for this credit is 5,000.
I see.
There is also one good thing about this credit is if you don't claim the $250 this year and you are still eligible to claim it next year, you can actually combine the credit.
Yeah.
So let's say I did not claim the $250 this year or next year or the year after, but I claimed it on the third year. Now I can claim $750 on 1 year. As long as I still have this, I can. So it carries forward to next year's. And it is, again, a credit, which means even if I don't have income, I still can produce a refund with this kind of a credit. Now, the only drawback with this one is people who are like students who have tuition fees, and they can claim something called tuition amount. So whatever they pay, it creates a tuition amount, a non-refundable tax credit again, and they can claim that against their income. If they decide to claim the Canada training credit, they have to deduct that or reduce the amount that they can use to calculate the tuition amount. So you cannot claim both for the same tuition fees. You can claim the Canada training credit first, the 250, and then reduce that amount from the tuition or the school. So let's take an example. If I paid $5,000 this year to go, or last year, that's the tax year, I paid $5,000 in Ottawa U. I can claim something called tuition amount, or what we call sometimes tuition tax credit. I can claim $5,000, and that gives me back 15% of this amount. So I can put in my pocket another $750, only if I have income to claim it against. However, if I claim the Canada training credit, if I claim 250 this year, I have to reduce the 5,000 by that 250. And now I can utilize both of them at the same year.
I see. Okay. Okay, so going back to the pandemic and 2020, I think most people are aware of these two terms, CERB, CERB, and CRB, right? These are the most common ones that people know. Are they actually the same?
No, they are not the same. So the CERB is Canada Emergency Response Benefit. This is the one that started when the COVID hit, and it was created in 2020. It was taxable income, the thing that most people was not aware of on the time, that it is taxable, but no taxes was held on the time they got the money. So this money, they got $2,000 per 4 weeks up to 28 weeks. So that the maximum that you can get was $14,000. No tax was held on this. So you had to have work for the year before for $5,000, or within the few months before you start to take, you made the $5,000. And then when you start to get this CERB, you had to have not have an income more than 1,000 within the 4 weeks that you got the CERB.
So to continue that, so what Sister Firouz was trying to say, that there was a condition on the application of CERB. There are two major conditions. The first one was, prior to you applying for CERB, or some people call it CERB, you had to have an income of at least $5,000 in the prior 12 months. Not only that, if you lost your income or you lost part of your income, you still can apply for it. The second condition was, in the 4 weeks period that you are applying for CERB, your income should not increase $1,000. So two conditions: $5,000 income in the previous 12 months, and $1,000 in every 4 week period you apply for. So CERB, you had to apply for it to renew your application every 4 weeks, and every 4 weeks there should be only $1,000. That's the condition, the two conditions. The issue that many taxpayers complained about, they were not aware that CRA did not hold taxes at source. What do you mean? If you have been working in Canada for quite some time, you'll realize that your salary is not exactly what you have discussed with your employer. Your employer has to withhold tax from that salary, from the wage, and that salary is paid to CRA. Same thing with any other benefits that CRA pays out, like EI, for example, employment insurance. They withhold 10% of the money that they have to give you, so that when time comes and you do your taxes, you can claim that amount that you paid in taxes to reduce your tax liability. The problem with CERB is no tax was withheld at source, and it paid $2,000 every 4 weeks. If we just look at the very first tax bracket, federally and provincially in Ontario, from every $2,000 you received, you should have put aside $400. How many of people who were actually in Canada or newcomers to our community knew about this? Very minimal. And this is what introduced the CRB.
So what is the CRB?
CRB, it was started after the CERB started on September 27. It's almost the same, but like CRA in this one held 10% taxes out of it. So if you're getting 1,000, like you get apply every 2 weeks, and you get 900 after taxes. So it was every 2 weeks, not every 4 weeks, I believe. And yes. They deducted taxes at source 10%. Is this 10% enough for you or no? This is different situation between people. Depends if you have other income or no. You have to be 15 years old of age. Again, you needed to have been working before and you had an income of 5,000 on the prior 12 months, you lost your job because of COVID, or your income was like less than 50% or 50% less than what you used to have before. Again, you had to apply. If you got this benefit, you're not allowed to have other benefits that we're going to talk about later on.
Okay.
You're not eligible for EI. You did not quit your job because you wanted to quit it. You did not turn reasonable offer jobs that came to you and you turn it off because you want to take the benefit.
Yeah, there's also a fine line that people always miss with CRB. You'll learn with time that CRA does not offer something for free. Something is always written in fine lines. So with CRB, there is a cap at an income of $38,000. The difference between CRB and CERB, CRB is improved. Remember when we talked about CERB, and I mentioned that your income every 4 months, every 4 weeks period you're applying has to be less than $1,000. CRB did not put that condition. CRB simply stated that your income for every 2 weeks period you're applying for has to be 50% or less than the same period 2 weeks last year. So let's say last year I earned $2,000 in the very first 2 weeks of October. This year I earned $700. Now I'm eligible. But if I earned $2,000 and then this year I earned $1,800, I am not eligible. That's one condition. The second condition was, say that you have other source of income. So people who have a reduction from $4,000 income to $2,000 income in the 2 months, do they still qualify? CRA said if in the whole year, from January 1st till the time that you receive until December 31st, that's a taxation year, if your income was more than $38,000 in total, you're going to have to pay back some of that CERB. So you're going to have to pay back 50 cents for every dollar you earned from that CRB. And that's the trick. 50
every
cents.
dollar.
So you're going to have to pay half of the money that you earned.
And the maximum of CERB, CRB, I mean, on the 2020 was $7,000.
Yeah,
because
so
it started on September and it's ongoing.
Yes, not many people fell into that trap yet, but it's there. So people have to read that fine line.
Okay. All right. So continuing the line about employment in 2020, unfortunately, due to the pandemic, a lot of people have actually lost their jobs. Some people were fortunate enough at least to get some kind of lump sum or severance package. How does that affect the eligibility for CERB or CRB?
See, so a lot of people thought that a lump sum payment for severance package disqualify you automatically from CERB or CRB. But what CRA basically stated is you're taking that severance package based on a certain amount of months or years you've been employed. So the severance package does not cover a month. It covers a whole period. So let's say I earned a severance package of $2,000 after working for 12 months. So I'm still qualified for CRB. Why? Because that $2,000 is divided on the 12 months period. That reduces the amount. So even if you see that check, a lot of people miss CRB during that time because of that issue. But no, the severance package is not a 1 month payment, is not a lump sum payment. It has to be divided on the work employment year that you have or period that you had.
I see. Okay. So students actually, on the other hand, right, did not apply for CERB or CRB. They were eligible for another benefit, CESB, right? This was eliminated as far as I know. So what options do students have?
So the CESB, the Canada Emergency Student Benefit, it was provided taxable benefit to support students who are high school student, like graduating from grade 12, and student from university who who stopped working or couldn't work because of COVID. So the benefit was discontinued on September 30th. So all students who applied for that got 1,250 per 4-week period. So the total they got it 5,000. But if you had an eligible dependent or you had disability, that amount went up to 8,000. This, as we said, it was discontinuous. So the total that the student got is 5,000 for that period that they got, unless they had a child or they had disability.
Now, because of the new and improved CRB, as we see, CRB basically eliminated the student benefit and the CERB benefit. So now students who work and they can prove a loss of income, they still can apply for the new CRB instead of the old one.
Okay, so the CRB is a combined of CERB and CESB,
yes.
Kind of.
Yeah. I see. Okay, I think I'm getting what CRB is now very confidently, but I'm confusing it with one other benefit, that EI. How does it differ then from EI?
Okay. It created a huge confusion. That's a good question. Employed individuals had to participate in a program called Employment Insurance Benefit. So when they lose their job, not when they quit, when they lose it, if they were let go, CRA had this program for them so that they can sustain them for quite a period of time. It's another type of benefits paid to employees who lost their job or went to maternity leave. Now, it was not meant for self-employment, for self-employed individuals. EI is compulsory for people who are employed, but it's optional for people who earn self-employment. And not a lot of people with self-employment had EI because it only paid benefits for maternity and parent leave. It did not pay benefits for job loss. So the CERB is different because it covered these two people. So it covered employees and it covered self-employed individuals. Or people even who have income from rental properties. And that's the difference between these two. EI, as we said, it's an old program. Taxes were withheld at source. People did not have to worry about that. But when it came to CERB, it was not held at source. And that's why we switched to CRB. So the CRB is more beneficial for people for students, self-employed, people who earn rental income, any other source of income. And if you receive EI for your job loss, you should not apply for CERB. So if you were insured with your employer, you should not have applied for CERB. However, some people made that mistake. Some people applied for CERB instead of EI. The Canada Revenue Agency caught some of them early in the program, but the others were not found. And now in the tax season, they received a tax slip saying that they earned CERB instead of EI, and taxes was not withheld at source, and they had no clue that was instead of EI. And that was a hit for a lot of people. As we said, from every CERB payment, $400 should have been put aside. People were not aware of that.
And in the beginning of the, sorry to interrupt, at the beginning of the COVID thing, some people applied for the CERB and they applied for EI, and then was not caught because they work separately. So they received money from here and received money from here. So now they have to pay taxes back on both of these.
Okay, so that was actually my question. If I applied by mistake for CERB while I was eligible for EI, what then?
If you received payments from both, one of them has to be returned. And by now, CRA has caught most of them. But if you received one instead of the other, you're still you're not in the bad zone. It's just that CERB was not taxed at source, so your tax payable is going to be more, assuming that you have source income from other sources. But they should be treated the same way. You're going to receive a tax slip, either T4A or T4E. Wait for that in your mail. And both of them are going to be, either of them has to be reported as benefits in your income. It's an income.
Thank you for that. Okay, so I think everyone now is up to date on their CERB, EI, CRB information and the difference. But were there any other benefits provided by the CRA apart from those?
Yes, there was the Canada Recovery Sickness Benefits, CRSB. They are all sound the same in the name.
Yeah,
so you can so this one was $100 per week in case you got sick or you had to stop working because of for self-isolation. You can get $500 per week, and it was for a maximum of I believe 2 weeks, Heba?
Yeah, 2 weeks in a row, like continuous
in a row.
2 weeks.
So yeah. So you had to have stopped working because COVID, or you got sick, or isolation. You have to isolate by yourself. So this one was tax held too, and you received $450 after the government took that tax on it. There was the other one, the Canada Recovery Caregiver Benefit, CRCB. It's almost the same. It's only you stopped working because you have to take care of your kids at home because they're staying home, there's no school, or you had to take care of someone else at home, and was again $500 per week, and the tax held, and you received $450 after taxes.
I just a note for people who are applying for these or have applied, or they received letters that they have to pay back. CRA also had it in a very fine line that you cannot combine benefits. So if you are staying home looking after a sick kid or a sick parent, or if you are sick and you're staying home, you cannot combine this benefit with the CERB or CRB, either or. Some people applied for multiples, and that's why they're receiving the letters and they're confused. These benefits are not meant to be combined.
Yeah.
I see.
So one or the other, you cannot have both of them.
Okay. I was going to ask if I can actually combine or not, but you preempted me with your response there, I guess.
Yes, right. CRA was very good in the response. We were very lucky in Canada to receive all these benefits from CRA. Even essential workers who had to work during this pandemic, they had it provided them with a wage top-up income benefit. So they topped their wages, and it's different from one province to another. But that benefit, that top-up, like they increase their wage, their minimum wage, that's considered an income. So they're still gonna have to report it as income in 2020 return, but at least it was a relief for them. Also the wage subsidy, Canada Emergency Wage Subsidy, that was a big thing. It was a new benefit program. CRA covers a portion of the employee wages. So it was meant to prevent small businesses from closing down because a lot of people couldn't, make it during this pandemic. So as an encouragement to employers, CRA offered to pay a portion of the employee wages. And here's also another fine line. If CRA covered part of the employee wages through this program, the employee cannot apply for CERB. So it's either or, again.
All right. It seems that there is a lot of either ors. I mean, everyone has to be very much aware of what they have received. Yes. All right. So it brings me to my next question is so how do I report these incomes now in my tax return?
Okay, so for these benefits, you're going to receive either T4A or T4E slip. So if you receive a T4A, you're going to report this on line 13000. It used to be called 130. So you're going to, depends on what benefit you received. So if you received the CERB, it's going to be on that T4A box 197. It has the CERB, how much you got. The maximum was $14,000. if you got the Canada Emergency Student Benefit, then it's going to be T4A box 198. If you receive the Canada Emergency Student Benefit for eligible student with disability, the amount will be on 199 box. And again, you report it on line 13000. If you got provincial assistant, this is going to be reported in box 200. They are all on T4A.
Yeah, these were new boxes introduced this year only to cover COVID. That's it.
So this is all these boxes on T4A. They are special for the COVID benefit that people got. You have box 202 for Canada Recovery Benefit, box 203 for the sickness benefit, 204 for the caregiver benefit. If you receive the T4E, then the amount will be on box 14, and again, you report it on line 119000.
Okay. The issue is people were applying for COVID benefits through two different venues. We have something called Canada Revenue Agency, and we have something called Service Canada. So each one of them issued a different slip number or slip name. So people should not compare, their answers at the end of the year. So because each one of them received a different slip. The T4E that Sister Firouz was talking about, that was initially meant for the employment insurance, hence E. But because people have applied through Service Canada, that's why they received this slip for COVID as well. So box 14 on that slip might include EI or COVID benefit, either or again.
And if people have my account and they go to their account with CRA, if you applied through CRA, you can see all the benefits that you got on the first page when you open my account. But if you apply through Service Canada, you can't see that on my account. Then you're going to have only the T4E to show you exactly how much you got into the benefits.
Okay, I'll be checking my mail very carefully now, I guess. All right. So I just want to go back, if I may. Now, a lot of people unfortunately made mistakes in applying to these benefits because they were unaware, and a lot of people were taken by surprise that they have to pay back taxes because CERB did not include that. So Justin Trudeau did his best, or at least maybe, to try to clear up the matter. Can you elaborate on the matter, guys?
That was regarding the definition of income when it came to business or rental income. We have many taxpayers who have rental income or business income, and no taxes are withheld at source. So what they thought, the $5,000 limit was referred to gross income. But what CRA meant was the net income, which means business income after you deduct business expenses. And it could be a huge difference. Some people, when they deduct business expenses, they end up with a negative amount. And that disqualifies them from the CERB. And again, that was not only written in a fine line, people did not understand it. It was not clear to taxpayers. So many letters were sent, I think, starting back in July. A lot of people were asked to pay back all their CERB payments that they got, the benefits that they got. See, Justin Trudeau, thanks to him, he came out and he cleared that misunderstanding. And he said, because the wording was not clear on the site, everyone is going to be excused. For now, CRA has cleared the matter, but whoever applied for this benefit, assuming that it's a gross income, and they did because it was not clear, they were going to get all the repayments back. So if you repaid CRA already, CRA is obligated to pay back that refund that you gave them. And anyone else who received the letter should just discard it. And from now going forward, it's a net income, it's not gross income.
For business people, self-employed.
Yes.
Yeah.
Okay. So only for these two. Okay.
Only for these two.
All right. Okay.
I actually have a lot of people who misunderstood that, because again, it did not specify exactly what kind of income. Let us clarify it. It's Canadian income or income earned in Canada. So for newcomers, you cannot report income you earned abroad before you came. It does not include foreign income, even if it was employment income. It's only income earned in Canada.
Correct.
Thank you for that clarification. I have one question actually from the audience, and it's a little bit different, but I just want to answer that question and then go back to my questions. This person is asking, so I have moved from Nova Scotia, Ontario in November. Should I be doing my tax return in Nova Scotia or in Ontario?
It depends on residency. So have they moved and they established a resident here in Ontario? For example, let's say they rent a place here or they own a house here. They're not here temporary. They live here. Then yes, they do apply for as an Ontario resident.
Okay, so if you've moved and changed the address and you've established yourself in Ontario?
Yes.
It's it's by the December 31st, wherever you live and you established by the end of the year, December 31st, where did you live? Where is your house? Where's your work? Then that's where you do your taxes for.
I see. Okay. All right. Thank you for answering that, guys. Going back here. So some people had to pay for childcare expenses, right? To hold their children's places in the daycare, right? While receiving COVID benefits. Can they deduct these expenses?
This year, again, it's a different year. Before, you had to have an employment earned income to go against your child expenses. This year, CERB and CRB, both of them is considered as earned income, and they can claim their child expenses as long as they did not move their kids from daycare to another daycare. They use the same daycare. So yes.
Okay. The reason is you have to prove that you paid these expenses to hold the child space in the daycare, not to apply for a new space in a new daycare.
Yeah.
I see. Okay. Now, speaking of changes to the workplace and trying to hold positions, I guess, in childcare, a lot of people were forced to work from home. Right. Yeah. And there is this new flat rate reduction of deduction of $400 that was introduced to employees. Right. Is that actually available to everyone?
It's available for everyone who work from home at least more than 50% of the time for at least a month. So if you had to stop working and work from home because of COVID, and you work up to maximum of 200 days, you can claim the 400. And it's a flat rate. It's a deduction. It reduces your total income to your taxable income. Yeah. So it is $2 per day for a maximum of 200 days. So some people start to work from home since the beginning of the COVID, and some people start later on say on June. So the maximum days that for the flat rate is 200. So it could be that you worked more than 200 from home, but the maximum that you can claim is 200.
And again, the key word here is employee. It's not a deduction meant for self-employed people or people who earn rental income.
Yeah.
Because they work from home anyways. So it's for employees who were forced to work from home.
Yeah.
Because of COVID or not. So even employees who used to work from home by contract, they still can apply for that flat rate.
Yeah.
I see. Okay. Some people have actually exceeded that because they incurred expenses working from home. So what do those people do?
There are two stream ways here. There are two options. Again, there are people who work from home due to their contract because say they're working for a company that's based in Toronto, but they are in Ottawa, and their contract ask them to work from Ottawa. But there also are other people whose contract is in Ottawa, but they work from home only due to COVID. So there are two streams. We do have a form that they have to fill. The form is called T777, 777s. And if you worked from home because of COVID only, you have to fill the form that's called T777S. S stands for short form. You can only claim home office expenses, and some of them, not all of them. The other stream, which you actually by contract work from home, you apply for the form that's called T777 without an S. It has a wide range of expenses that you can claim. You can claim your home office, you can claim your vehicle expenses, you can claim capital, like depreciable values. There's so many other expenses that you can claim. But either or, there is a form that has to be signed by your employer to allow you to claim these expenses. So let's say you are claiming the expenses because you worked at home due to COVID. Either employer has to stay in the form, and the other form is called T2200 that the employer has to sign. They have to state that you're working from home at least 50% of the time. And you need that form, and you have to keep supporting documents for everything you claim, because this form is highly audited by CRA. So you need all the forms. You cannot claim expenses that have been reimbursed. So if your employer asked you, for example, that you need to buy papers or printer ink, and he reimbursed you, you cannot claim these expenses anymore. The other form, if you are working from home by contract, you can claim even your vehicle expenses if you had to go back and forth from the office. They are located in Ottawa or any other place. You can claim some tools if you're working as musicians, for example, if you're working in forestry. So there are a lot more that you can claim by that. We can go through what you can or cannot claim if it's a question.
Just one thing, that if you're claiming the flat 400, CRA won't audit you.
Yes.
They're not asking for proof of that. They're not asking for receipts. If you're claiming either the T77S, the one special for COVID that you're claiming your home expenses, or the regular T77 that employment expenses has been for a long time there, you could be audited. You need your receipt to be available if CRA asked for them.
And just is it T777 or T77?
No, T777. Sorry.
Oh, T777. Okay, thank you.
So the form that your employer needs to sign, it's called the T2200. That's for the regular employment expenses, or the T2200S, and that's the special one for COVID. That's only home expenses on it.
Right.
So the T2200S has only 3 questions in there. But if you go to the T2200, the regular one, has I don't know, 14 questions maybe.
Yeah, it has 2 pages worth of questions.
2 pages, yeah. So the S is the new one for the COVID. It's only for home expenses. Has nothing to do with other expenses.
I see. Okay, so another hot topic regarding to employee expenses. What is it that I really actually can claim? I think you touched upon it, but I'm just wondering if you guys can elaborate at what qualifies as a employment expense.
If you're talking only about home expenses, again, due to COVID, anything that does not have a depreciable value, meaning I can claim a portion of my rent. I can claim a portion of my electricity. And by portion, I mean I'm using an office in a 5-bedroom home. I'm only claiming 1 out of 5 because the rent is paid for the whole home. Electricity is paid for the whole home, but I'm only occupying one portion of it. So I am claiming a portion of rent, electricity, maintenance, minor repairs for that room, office supplies, the basic cell phone service plan, not the activation or not the cell phone itself, and the long distance calls for employee. This is all for employees who earn salary. There are employees who earn commission. Employees who earn commission, like people who work in Brick, people who work in Rogers, maybe, I think they still earn commission. These people can, if they work from home, they still can claim a portion of their property taxes or home insurance or lease of equipment, not the equipment price, but lease of printer, a lease of the computer. You cannot, under these two, claim any depreciable values. You cannot claim a new chair, a new desk, a new computer. You cannot claim any of those.
Especially people during COVID, a lot of people bought desks, chairs, screens for their computer. All this stuff you cannot claim.
You cannot claim.
So if I bought my own stuff, as in my own furniture, I cannot claim that.
No, because it's considered also for personal use. It's in your home. And they see COVID as a temporary measure. Eventually, these desks and chairs and these depreciable products, they're going to stay in your home forever. Not forever. Like, say the depreciable values is 5, 7, 8 years. So you're not allowed to claim CCA on those, or what we call capital cost allowance, depreciation value. And that's only if you're claiming due to COVID. Now, if you are claiming employment expenses by contract, because you are contracted to work from home, oh my God, you can claim accountant fees, advertising fees, motor vehicle expenses, food, beverage, parking, everything. You can claim.
So the key difference here is that, one, your contract states that you're working from home, versus one, you're working from home because it's a temporary measure due to COVID.
Exactly.
Right? If it's by contract from the employer that you're working from home, go nuts, claim a lot of stuff. But if it's due to COVID, then no, there is a lot of limits. It's that $400, or if you want to go above, fill in those forms, the T77 and T77S. Is that correct?
Yes, and this is where the T2200, the regular employment expenses, that you can claim a lot of things, or the T2200S, that's the one special working due to COVID.
I see. Now, just going back to the whole thing about claiming office space in my house, right? Is there a limit on this space? So say I have, if I use my business, if I have a business, or if I have furnished, let's say, my basement, right? Can I claim my entire basement? So I have 3 floors in my house and I have a basement. Can I claim the entire basement?
If you're working from your basement as your office, you can. So it's where is the space that you're using as an office, or you're working from. So some people work from the kitchen, on the kitchen table, and some people stay on the, like my husband, he's in the basement. So some people, they are on the bedroom. So depends on where you're working. So you have to, like, it's the square feet of the space you're using against the whole home. So you cannot just say I'm working for home and my percentage using home for work is 100%. You have a percentage that you're using from that home, unless you're only living in one bedroom, and you're like living there and working there in one bedroom. Then, but like usually people.
So usually with basement, let's take the close scenario possible to reality. You have a basement, it's a big basement, let's say it's 400 square foot, or let's say it's 1,400 square foot. You're not using the whole basement for your job. You're using a portion of the basement for your work. So you're going to have to reduce by that portion. So I'm going to draw a line around the area that I'm using for an office, and measure the square footage of that area against the square footage of the whole house. You
And
can
this
only
is,
claim the basement if you're using the whole basement, but if it's also used for personal use, you can't.
cannot. And this is a mistake that a lot of people do. They don't figure out that they have to put a percentage. So they put 100% as a business use or a home use, like for work, and then that's wrong because you're not going to be using your whole home for working from home. You're using a part of the house.
Another thing that you might be interested in is, what if I have an office and I'm sharing it with my husband?
Yeah.
What if both of us use the same office? It's an office, it's work. It's only designed to be used for work. There is 168 hours in the week. I have to divide it by how many hours I am using and how many hours he is using.
Yeah.
So what if though both of you are working in the office at the same time?
Then you have to divide. You have to divide half of the office I'm using, half of the office he's using. So I can't claim the whole square footage for the house. Yeah. I'm only claiming half of it. Sorry, for the office. I'm claiming half of the office and he's claiming half of the office.
I see. Even in that, they get you, eh? Okay.
Yeah, and unless they're like, say they are like working both from home, but one of them working from the bedroom and the other one is working from the basement, then each one of them can claim their own space.
Yes.
They don't have to divide that room between both of them.
Okay. I have a question here from the audience. I'm going to try to understand a little bit before I ask it. I think the person's asking about it's either rental income or expenses that you can claim for property taxes or part of your mortgage. Can you claim any of these expenses against your mortgage? I'm not sure if that question makes total sense, but
okay, let's try to rephrase that. Do they have rental income?
So let's assume that they have rental income.
If they have rental income, let's say they're renting the whole unit. So they have a house and they're renting the whole house, then they claim the interest portion, property taxes. They claim everything that has not to do with the mortgage itself, not the actual mortgage, not the actual principal payment of the mortgage. They cannot claim that. But the interest and the property tax, it can be claimed against the income coming from that unit. If they are renting a portion of their house, let's say I have my own house and I'm renting the basement, or I'm renting one of my bedrooms to a student, I claim, again, I have to prorate the expenses only to that portion, a percentage only to that portion.
I see. I hope that answers the question from the
so.
person who is asking
it. They can claim the mortgage, they only can claim the interest on the mortgage, and they can claim property tax. If they do snow, like the company who remove the snow, they can claim. If they pay some of the utilities for the house, not the tenant paying, any expenses they pay for that rental house, they can claim, but not the mortgage by itself.
I see. Okay. So I'm gonna give a few minutes here to see if I get any other questions from the audience. But while I wait for questions, I just have the generic questions.
Can I say something before you go there?
Of course.
Yeah, if people have kids born in 2003, before June 1st, they have to file 2020 so they can get GST and Trillium. So any kids born up to before June 1st, like that's May 31st, on 2003, file 2020, these kids gonna get GST and Trillium.
I see.
Okay? Even if they have no income, like zero income, it's okay. It's an information return. They do it, they receive GST and Trillium.
Okay. So
these are federal and provincial benefits. You don't report these in your income for next year. It's just benefits that are given to people with low income or families with low income. So teenagers or young people who are born again, the same like what Sister Firouz was trying to explain, even if they don't have income to report in their taxes. A lot of people miss that. They think that if I don't have income, I don't have to report. You are missing on some free money given to you, which is called GST credit and Ontario Trillium benefit. It's a provincial credit.
Yeah, that's what my daughter, she just received her first GST payment. I say, oh, it's free money. I say, yes.
All right. And does that vary per family situation, or is it a set amount per child?
It does. It has a cap. So if your income, let's say, just for easy math, reach $40,000, you're not going to be qualified. So you have to make a lower income than that in order to be able to qualify for the credit.
And the kids, when you have kids less than 18, this GST amount, it is with the head family amount, so the family amount. But when you're over 18, you start to receive this by yourself, away from your family. So it's your own income, not the family net income. That's why teenager 19 and 20, 21, usually they don't make a lot of money, so they get almost the full amount of that.
Oh,
Or
I
the
see.
GST, the federal credit, and is the Ontario credit.
Cool. I actually have a question here from the audience. This person is asking if they are claiming working from home or claiming working from home expenses, is up to $400 only. Could I claim some of my property taxes on top of that?
No, there's a list of expenses that you cannot claim. Here we go. You cannot claim depreciable values. You cannot claim your mortgage interest. You cannot claim your principal mortgage payment. You cannot claim capital expenses, replacing windows or flooring, not something that major. You cannot claim office equipment, printer, fax machines, briefcases. You cannot claim monthly basic rates for landline telephone. You cannot claim the cell phone, the purchase of the cell phone or the connection, that activation fee that you pay when you activate your phone. You cannot claim that. Computer accessories, you cannot claim that. You cannot claim electronics in general, like speakers or monitors or television. You cannot claim those. Now, the property taxes can only be claimed by commission income employee, which means you in your contract, you are earning commission, not only salary. And you have to claim that against your commission income, not your salary income.
And again, if you applied for the flat 400, you cannot claim any expenses. It's flat 400. No expenses, yes. No utilities, no rent, no nothing. It's the flat 400. It's flat. It's a deduction 400, and that's it. And that's why CRA is saying whoever claimed the 400 flat 400 rate, we're not gonna be asking or questioning that deduction.
Yeah.
But if you're claiming the other regular deduction, the T77S or the T777, then they could ask you for a proof of expenses.
I see. All right, I'll wait another minute for questions, but while I wait, I will ask for generic tax advice for this year. Is there anything else that I should do or be wary of so I can not be charged if I'm going to be owing, or that I can maximize what I'm going to be getting back?
Let's just begin by saying that do not compare. It's not a test. So don't compare your tax situation with your friends and family. Everyone has his own tax situation. And for example, claiming medical expenses for you might not work for your friend or for your neighbor. So if you are really lost, you need to seek some tax advice from professionals. But let's say that people miss some credits. So some credits missed that if we, explain them now, maybe people can catch up. One of them is medical expenses. Some people think because they have insurance, health insurance, that they are not qualified to claim any medical expenses. Keep in mind that the health insurance pay only a portion of your medical expenses, not all of it. Say that I have an insurance that pays $500 a year for chiropractor. what happens if I pay $1,000 a year in a chiropractor? The other 500 can be claimed as medical expenses. So people miss that. You can claim your LASIK surgery, eye LASIK surgery, as medical expenses. You can claim your chiropractor. You can claim hearing aid. A big one that's always missed, travel for medical reasons. Say that, God forbid, someone has a disease that cannot be cured in any hospital in Ottawa. And because of that reason, they had to travel more than 40 kilometers outside the city to another hospital to receive that treatment. If they have a letter from the doctor stating that this treatment is not available in Ottawa, they can claim those travel expenses back and forth.
Okay.
If they actually, so another thing, if they actually traveled more than 80 kilometers outside of the city, now they can claim the gas rate for travel expenses, accommodation, meals, parking. So that's one is very missed. It's missed greatly. Legal fees is another thing that's missed. I've seen lately in the last year, because loss of income and COVID, a lot of people were let go and they were not paid their severance package or their wages according to the contract. If you choose to file a lawsuit, that legal fees to establish a right to your salary is deductible. You can deduct this from your taxes. Also, parents or single parents who are filing to establish a right to custody, to child custody, or to increase the payment for the child custody, the person who's receiving the payment, let's say a mother is paying child support to a husband. If he's the one who is trying to increase that child support payment, he can claim that legal fees. The person who's paying the child support can't, but the other person can. And also it's greatly missed. Donation is a very, very big issue with donations. You get a lot of money back when you donate, thank God. But donations are calculated a little bit different than any other credit. For every $200, the very first $200 you pay in donation, you get back 15%. That is $30. Anything you donate after the 200, you get back 29%. And people don't know that you can combine 5 years worth of receipts for donations. So I don't have to, by the way, I did that once. So I did not claim my donations for 4 years. And then I claimed them, I combined them all in 1 year. So I got 15% back from that's federally only. There is more to top up that with the provincial. 15% for the first 200, 29% from the remaining. So it is advisable. If you're already receiving a refund, don't claim your donation now. Combine them and claim a bigger amount later on.
I see.
As long as you have income to go against it, because it's a non-refundable credit.
So if
another thing was also RSP. Oh, sorry, go ahead.
So if I just to elaborate on Sister Firouz, so if I have money at home but I'm not making any income and I can donate, if I claim those, I'm not going to get any credit back.
No, because it's a non-refundable. So
Okay.
it's not a refundable credit. It's a non-refundable. So it helps reduce your taxes liability to zero. But if you already have zero taxes to pay, then nothing. It's just going to be wasted.
I'm not trying to discourage folks who are retired, but it's just for your information.
But people who are retired, they have income.
They have income. They have
Oh, there you go. It's a good segue.
People who are retired, they have income. As long as you have income to go against it, and it's sadaqah for Allah. So
and it's
and
also
have it later on.
It can be shared between spouses. So maybe I donated, but I'm not making income, and my spouse, my husband, has a lot of income to claim it against. He can claim that. We're just throwing the term non-refundable and refundable. Maybe we should have explained that from the beginning. Non-refundable tax credit means non-refundable. So refundable is the portion that reduces your taxes. Non-refundable means that I can reduce your taxes until it gets to zero, but I cannot give you a refund. So if I have medical expenses worth of $4,000, if I only need 2,000 from this to reduce my taxes to zero, the other 2,000 are going to go to waste. So there's no point of claiming it. To avoid this from happening to donations and CRA encouraging people to donate, they said, okay, if the donation are not going to make any difference in your refundable, if you refund this year, let's combine them for next year. We can give you a break of 5 years. So combine them next year, or the year after, the year after. So they're trying to encourage people to donate by giving them this tax break.
I see. Okay. I have a couple of questions here from the audience. This question is, how can someone claim public transport expenses? Example, paying for a monthly pass for OC transportation to get to work.
Okay, so this was eliminated few years ago. So now only on Ontario, if you are a senior over 65, you have that credit to claim, only for seniors.
Only for seniors. So if I'm a student, that's not something that I can claim.
Not working anymore. It's only for seniors on the Ontario portion of the tax return, not on the federal. It used to be on the federal.
All right. Okay. I have another question here from the audience. It's saying, should profits that are earned in RESP accounts be reported as an income?
No, because you have not withdrawn that amount yet. As long as this money is not in your hand, it stays in the RSP land. So you don't claim that. Your RSP has to grow because you're putting them in investment. So it's known that it will grow until the day you withdraw the money for retirement. This is the only time where you pay taxes.
I see.
And speaking of RSP, here is another tax tip. RSP it's basically a short form of registered retirement saving plan. So you're the one who have to open this account with your financial institution. So what I go into and tell RBC, for example, I want to open an RRSP account. I want to put money monthly into this account, into an investment. It grows until my retirement. So CRA gave a tax break with that. So it says every money, every income, or every portion that you're contributing to the RSP, it's deducted from your income, as if you did not make this income. So if I make $20,000 in employment income and I took $2,000 from that and I put it in RSP, I have to deduct that from my income. That makes my income for the year, or my net income now for the year, 18,000 instead of 20,000. There is something, I mean, we only have like less than a few days left for that. RSP contribution period is divided into two. You can contribute into your RSP from March to December of 2020. And there's another period, we call it the very first 6 days, the first 6 days of the tax year, which means you can still contribute January and February of the 2021. Yes, we are reporting income from 2020, but only for the RSP. You still have the window to contribute, and you still have few days left until the end of this month to contribute into your RSP. It's a great deduction. So an example, let's say that federally, I am in the 15% tax bracket. I have to pay 15% on my income. So for every $1,000 I put into my RSP, I get back 150. This is how good it is.
I just want to, sorry, just a quick question, because my hearing is not so good, unfortunately. Is it RRSP? Are you talking about RRSP or RESP?
Also, the question was RESP or RRSP?
Yeah. So the question that was asked was for the RESP.
Oh, that's the children one.
That's
yes.
The money for the school. No, unless unless they take the money out for the school, then that is where it's reported.
Okay, so RESP again is the Registered Education Saving Plan. it's meant for children. So I open an account for my child. It works similarly to the RRSP, but this is meant for the child. So I contribute to the child plan. There is no deduction for my contribution because I contribute the money after I pay taxes. So it's money that I have in hand. The RRSP, I don't receive that money. I put the money in my account and my RSP before receiving it. But RESP, it's not my income, it's the child's income when he turned the age to go to school. So he's going to receive a slip, a tax slip with the income from that account. He's the one who reports it as an income, not me. Unless my child decides not to go to school, he returns that money to me and I'm the one who's paying taxes on that money. The RESP is different in a way that the government is encouraging it. So the government is topping that with the government grant and bonds. So the government gives money to people who contribute to RESP. If the child chooses not to go to school, that government portion, that government contribution has to be sent back to the government.
I see. And the contribution that the government adds for the RESP, that's until the age of what?
Until the age of 21.
Until the age of 21. So if I have kids and I have an RSP, the government's gonna top off by giving me grants, bonds, etc., until the age of 21.
There is a maximum. So some people can get all their grant within the first few years, and some people start the program late. So they don't get that grant until later. Like I don't have to start the program when my child is 2 years old. I can start the program when my child is 14. I only have 4 years left. So this is where the difference is between one person to another. There is a government top up, and there is bonds for people who are in low income, and both of them are different situation. I think the total every year you get $500 maximum on your contribution.
I see.
So and that's up to I think $7,000 per child.
Okay. You said, sorry, I'm just, again, my hearing is off. So you said when that you can contribute when the child is 14 and you have 4 years, but you're saying up to the age of 21.
It's up, yes, but after that age you cannot contribute anymore. I mean, the government is not going to contribute to me. So here how it works. It's the government tops up 10% on the first $500 that you put in, and then it gives you 20% per payment to a maximum of $500 per year. And the age of the child, when the beneficiary turns 17, my child or children, they can get up to 7,200. After the program has to end at some point. When the program ends after that many years, at 21 years, when it ends, you have to do something with this money.
So, I see.
So every child under the age of 18 gets that grant, but not more than that. So that the program has to end whether or not the government paid all the grants. I can still keep them. So the government can pay all that 7,200 in the very first few years, but my child is still young. I still have the money in the account. It's growing by investment from the institution, from RBC or from Manulife. It's growing by investment. I can still keep the money there.
Okay. And do I have to report the profit on that, whatever?
No, it's not your income. It's your child's income. It's the child who reports the income. So the child reports, the child doesn't report your contribution because you already pay taxes on that. The child reports the investment and the grant as income.
I see. Okay. I have a couple of questions here for you. So this person's asking about refundable credits, right? Is carry forward tuition credits considered refundable or non-refundable? And how can these credits be used?
Okay, so tuition, go ahead, Heba.
Tuition is a non-refundable tax credit, which means you get back 15% of the amount. if I have no income at all, but I went to school and I have this great amount of, tuition amount that I want to claim, because it's a non-refundable tax credit. If I claim it when I have no income, it's going to go to waste. So Canada CRA allows you to carry that forward indefinitely. Or I can transfer it to my husband. I can transfer it to my parents if they need it. But you cannot claim it if you don't have an income. It's a non-refundable.
I see. Someone's asking that we confirm. So you said that the maximum that someone can get per child from the RSP is, or from the government, sorry, is 500
per year.
Per year.
Yeah.
So it's 500. It's not 1,000.
No.
In the first year, it is.
In the first year.
Yes. If for example, my child was qualified to apply for it last year, but I didn't, and I applied for it this year instead. I can get last year and this year together, but not more than that. So if my child was born 4 years ago, I cannot get the 500 4 years ago. So I cannot get 2,000. I can only get this year and last year. That's the 1,000. So most probably people are thinking because they just applied recently and they get that 1,000. So they think you get that every year. No, it's a 500.
I see. Okay. Switching gears back to RRSPs, right? So this person is asking, it's like, I'm a first-time home buyer, right? And I have, so sorry. I'll ask it exactly as they have asked. Okay. So if I extract money from the RSP for the first-time home buyer program, does that count as income for the year?
No, it's a deduction. Actually, the home buyer plan, when you buy your home for first time, you did not own a home for like last 5 years, and you got RSP money out to pay your first payment out of your RSP. This is it's a non-refundable tax credit.
No, that's the home buyer amount. He's asking about the home buyer program. A home buyer plan. So as of last year, I believe that was last year or the year before, CRA has increased the limit of how much you can withdraw from your RSP to put in a down payment. It used to be $25,000. Now it's $35,000. That money, when you withdraw it, you don't pay taxes on that full amount. So they give you a grace period of 2 years. They say that you're moving to a new home, maybe you have moving expenses, lawyer expenses, you have furniture expenses. So we're gonna give you a 2-year grace period, and then you're gonna have to start paying it after that. They give you 15 years to pay off the 35,000 that you don't have to take the whole 35,000. You can take less than that, but that's the maximum. So if you took $35,000 and you divide that by 15 years, so we will go 35 by 15.
It's a little bit more than 2.
Yeah, so it's 2,300, close to 2,300 every year that you have to make as an RRSP contribution. So you have to contribute regularly to your RRSP and then designate that payment to your home buyer plan. If you fail to do so, that 2,300 will be automatically paid back to your RSP, and you're going to have to report that amount as an income.
I actually believe I fell in that once.
Yeah.
So.
Yes.
I just want to say to people who buy home for the first time, they can claim the home buyer amount. That's a 5,000 non-refundable tax credit.
Yes, a lot of people miss that.
A lot of people who buy a new home for first time, they can claim that amount. And it's really, if you have an income, it does help.
Okay. Now, I'm assuming that if you're going to be taking out from your RSP for the home buyer plan, there are certain conditions. I don't know if you have to know the conditions or you have to fill in something to tell you whether you're eligible for it. I remember when I bought my house more than 20 years ago, the condition is that I'd have no home before and it's brand new. I'm just wondering, has that changed? Are you guys aware if there's anything?
Yes. So it has to be a first home. or you don't a first-time home, and you should not own a house in the prior 5 years. So let's say I owned a house and I used my home buyer plan, and now I paid it off and I sold my house. I have to wait another 4 years or 5 years. Like we include this year, existing year in the calculation. So I have to wait 5 years before I can apply for the program again. That's one condition. The second condition, the very first plan has to be paid off before you apply to the next. The other change that happened last year is that they said if there is a breakage in the relationship, say that God forbid people got a divorce, they sold their family house and they bought a new house, you don't have to fulfill that 5 years condition anymore, because now you're starting brand new.
And again, is the condition on when we say new home, is it a newly built home, or is it a new home for you?
A new home for you,
yeah. A new home for me. Okay.
Again, you have to not owning a house last 5 years. Like say you had a home 20 years ago, then you sell it, you live in a rent, then now you come back, you buy, it's considered a new home for you because you did not own a home last 5 years.
I see. So the condition is that buy, sell, rent for or pay rent for 5 years and then buy a home again. I see.
You're eligible for that, yes.
I see. Okay. I have a couple of more questions for you. So I'm going to just take a quick read here. While I take a read, I just have questions about TFSAs, right? I know a lot of people, because of the harsh conditions of last year, may have had to withdraw some amounts for a TFSA or contribute to the TFSA. Do you have any advice or any words of caution?
TFSA is very tricky. It's exactly reads with it, tax-free saving account. So any money you put in this account and it grows in investment, it's free of tax. And to limit people from putting all their money in this account, there is a limit per year on how much you can contribute. So in the past few years, including this year's, it's been $6,000. You can contribute $6,000 into this account. It starts from the age when you're 17. The very first few years, it was $5,000. And then I think in 2015, it jumped up to $10,000 in that year, went back down to
$5,500.
Yes, and then it increased to $6,000. Here's a trick, and that everybody falls into that trick. Say I've never contributed in my tax-free saving account, and I either turned 17 in Canada or I came recently to Canada. Let's just say, for easy math, my limit from all the previous years have been, saving up my limit. I have not contributed at all. I have $50,000 limit that I can contribute. I can go to the bank right now and put the $50,000 into that account with no penalty whatsoever. Even though the contribution limit for the year is $6,000, it's just because I've never contributed before. If I go to my TFSA account and I withdraw even $1, if I try to put money back into this account, it cannot increase the year's limit, which is $6,000. Like I can go and take and withdraw out $10,000 from that account. Now I have 40,000 and I have 10,000 limit free for me. I cannot go back and put that 10,000 because the year's limit is 6,000.
You have to wait for the next year.
You have to wait the next year to be able to do that. So once you withdraw, you have to obey by the year's limit, not the free limit that you have in the account.
I see. Okay, thank you for that. I have a couple of more questions, and then I would like to wrap it up. I know that it's a hot topic for a lot of people, different situations, but just for respect for everyone's time. This question is, I'm a Canadian citizen. I have moved to the UAE for work. I have been out of Canada for more than 6 months last year. Do I have to pay taxes on my income to the Canadian government?
That's a very tricky question too. but it's a good one because a lot of people have fallen into that. I have many friends who had moved outside because of COVID. They work from home. They don't have to stay in the country. And because they're not in the country, they think they don't have to file their tax return. There is something that we call breaker rule. You have to cut all ties with Canada so that you're not considered a Canadian resident, which means you cannot own a house here, you cannot have your health card, you can't have a Thai resident in Canada so that you don't pay taxes. So let's say I have a couple, a husband and wife, and she stays here with her kids because they go to school, and the husband, because of COVID, he decided to move back to United Arab Emirates to work there. He is not in Canada, but he has ties. Even though he doesn't own the home, his wife and kids are in Canada. So he has to file the world income, which includes the income that he earns from UAE as income. Yeah. But if he moved out with his kids, with his wife, and he doesn't have a house here, he doesn't have ties here, he canceled his health card, there's no ties, then at that point, he's not considered a Canadian resident. He is a Canadian citizen, but not a Canadian resident, and he does not have to pay taxes.
Some people moved back during COVID, but they still work in Canada, but they're working from, say, Egypt or Emirates or wherever they go. They have income from Canada. Then they have to do their taxes.
True.
Okay.
So it's not because you left 6 months and you're not here that you're not gonna have to pay your taxes. If your income is from Canada, any income from Canada, even if it's only interest from the bank, you still have to file your taxes.
Yeah, that's another one. We do have visitors who came to stay with their loved ones here in Canada. They are not Canadian citizens. They don't have the citizen. They don't even have the PR card. But if they stayed here for more than 183 days, yeah, and they open, for example, they have a saving account, they bring their money abroad and putting into that saving account. That saving account, now that money earned is considered Canadian income because it grew in a Canadian bank. They have to pay taxes on that amount, on the investments.
So the Canadian tax, it has to do with the residency or no? It's not like with citizenship. It doesn't matter if you have citizenship, but you never lived here, you don't have to pay taxes. But if you live here or you have ties to Canada and you have Canadian income, you have to pay taxes on that.
I see. And the last question that I have for you from the audience for today is, I have a big accumulated contribution room in my RSP. And currently I have a lump sum amount that I can contribute. Is it true that if I realize that I need to withdraw some money later, I would lose whatever contribution room remaining?
No, when you withdraw the money? No, when you withdraw the money that, no, you don't lose the room.
So I do not. Let me ask the question again then. I have a big accumulated contribution room in my RSP, and currently I have a lump sum amount that I can contribute. Is it true that if I realize that I need to withdraw some money later, I would lose whatever contribution room remaining?
No, you don't.
I don't. No, only when you get the money out, you have to pay taxes on it.
No, he's talking about, he's talking about the room. So let's say that he has $50,000 deduction limit or contribution limit, and he decides to put $40,000 this year as a contribution. Later on, he withdrew that $40,000. Does he lose that $50,000 that he had initially in contribution room? No.
No.
I see. All right. So that is it for the questions that I have. I really would like to thank you both very, very much. A few folks have asked for your contacts as they have other questions. Some of them may be a little bit more personal or very much tailored to their situation. So I'm going to try to share my screen here quickly, and I pray, inshallah, that I can share it So can someone let me know if they actually can see my screen or not?
Can see it.
You can see it. So again, thank you again very much, Sister Firouz. This is Sister Firouz's contact. She again works at H&R Block. And Sister Heba, thank you very much for that. And her contact is, it's actually, sorry, Heba at HebaTaxInsights.ca. She gave me that earlier and I forgot to correct it. So let me.
I'm still seeing mine, not Heba's.
So
You're still on my page, not Heba's.
Pardon?
You're still on Firouz, not Heba. That's the one, the screen you're sharing. It's still mine, my name, not Heba.
They're both of them side by
both
side.
of them are side by side.
Oh, I can see the other one. That's
there we go.
sorry.
All right.
Now
So,
I can see.
Okay. Well, thank you very much, everyone, for tuning in. Jazakumullah khair. And I hope that this has been beneficial to everyone. Again, I'm going to squeeze in a little ad here for KMA. Please do not forget to contribute to the KMA project. It's ongoing. We need your help. So please donate generously, especially now that you know that you can benefit greatly from the charity tax brackets. Keep your receipts for 5 years and inshallah you'll get a great return there. Okay, Jazakallah khair.
Jazakumullah khairan. Thank you.
Jazakumullah khair.
All right. Assalamu alaikum wa rahmatullahi wa barakatuh.
Alaikum assalam wa rahmatullah.